In a move that has sent shockwaves through the global aviation industry, a major U.S. aerospace leasing company has finalized a groundbreaking $2.2 billion order for China's C919 passenger jets, marking the first large-scale American purchase of a commercial aircraft developed entirely by the Commercial Aircraft Corporation of China, or COMAC. For decades, the skies have been dominated by two titans, Boeing from the United States and Airbus from Europe. Their duopoly seemed unshakable, but this deal signals the beginning of a profound transformation in global aviation economics. The C919, a narrow-body jet designed to compete directly with the Boeing 737 MAX and Airbus A320neo, represents the culmination of over a decade of research, state-backed funding, and relentless engineering from China's rapidly advancing aerospace sector. Its entry into service already disrupted regional markets in Asia, but a U.S. firm placing such a massive order is something few analysts believed possible even a year ago. The transaction reflects not just a business choice, but a calculated acknowledgement of COMAC's maturing technology and the shifting balance of trust in international aircraft manufacturing. The American buyer, motivated by a mix of cost efficiency, diversification, and a desire to hedge against Boeing's ongoing production delays, viewed the C919 as a viable alternative, a reliable, efficient, and cost-competitive aircraft ready for Western routes. The $2.2 billion order, which covers an initial batch of around 30 C919 jets with options for more, is expected to be delivered over the next 5 years, subject to FAA validation and supply chain coordination between COMAC and Western component suppliers. The significance goes far beyond simple fleet expansion. This is a strategic turning point where a U.S. company is effectively validating China's decades-long effort to enter the commercial jetliner elite. Behind this deal lies a decade of quiet development and persistent engineering triumphs. The C919 project began in 2008 with the ambition to end China's dependence on foreign aircraft. And after nearly 15 years of rigorous testing, international collaboration, and certification hurdles, COMAC finally delivered its first operational units to Chinese airlines in 2023. Designed to seat between 158 and 192 passengers and offering a range of up to 3,000 miles, the jet boasts a new generation aerodynamic profile and cutting-edge LEAP 1C engines supplied by CFM International, a joint venture between General Electric of the US and Safran of France. Its digital fly-by-wire control system, lightweight composite materials, and fuel efficiency metrics put it on par with, and in some routes even ahead of, its Western rivals. When test pilots from the U.S. leasing firm visited COMAC's facility in Shanghai earlier this year, they reported that the C919's cockpit design, avionics interface, and operational stability rivaled that of the latest A320neo series. One executive commented anonymously that the aircraft felt surprisingly Western, modern, intuitive, and sturdy. Such first-hand impressions helped shift internal boardroom opinions, convincing decision-makers that diversification away from Boeing and Airbus was not only possible, but strategically wise in a post-pandemic world, where aircraft demand, delivery schedules, and maintenance costs have become volatile. From a geopolitical standpoint, this deal also carries symbolic weight. Aviation has long been a mirror of industrial strength and national pride, and a U.S. firm's willingness to spend billions on a Chinese jet challenges the traditional hierarchy of technological prestige. It's not that Boeing has lost its engineering edge, but years of setbacks, production delays, and reputational damage from the 737 MAX crisis have eroded confidence among international customers. Meanwhile, COMAC has steadily built a reputation for reliability and incremental improvement. The Chinese government has poured tens of billions of dollars into aerospace research, training programs, and manufacturing infrastructure to ensure that the C919 meets international safety and performance standards. Its components are sourced from a global network, engines and avionics from Western firms, materials and electronics from domestic suppliers, creating an ecosystem that bridges continents rather than divides them. Ironically, this hybrid design has made it easier for U.S. regulators to assess its compliance since many of its systems already meet FAA certification benchmarks through their Western origins. The order's announcement drew immediate responses across the aviation world. Analysts at major financial institutions called it a seismic vote of confidence in COMAC's future. Stock prices for component manufacturers connected to the C919 program surged in both Shanghai and New York. At the same time, Boeing and Airbus reportedly began internal reviews to assess how this deal might influence long-term market shares. Boeing's executives, while outwardly dismissive, are privately aware that the psychological effect of this purchase could be as significant as its economic value, signaling to airlines and leasing firms worldwide that the C919 is now considered a legitimate alternative, not just a political or regional curiosity. Within hours of the announcement, Chinese state media celebrated the contract as a victory for innovation and international cooperation, while U.S. outlets framed it as a pragmatic business decision in an era of global supply interdependence. As deliveries prepare to roll out starting in 2026, the two sides are finalizing agreements on maintenance, pilot training, and spare parts logistics, areas that will determine how smoothly these aircraft integrate into American fleets. COMAC plans to open a technical support hub in the United States, possibly in Texas or California, to manage after-sales services and ensure compliance with U.S. maintenance standards. For the leasing firm, the strategy is clear. Offer airlines across North America, Latin America, and the Pacific region a new, affordable alternative at a time when aircraft shortages and backlogs are constraining fleet expansions. Early leasing rates for the C919 are expected to undercut comparable Boeing and Airbus models by nearly 15%, creating a compelling financial argument for smaller airlines seeking to recover from pandemic-era losses.